Welcome back to another episode of Investing Explained. Here's today's question. It really makes me think of the quote, "It's hard to make predictions, especially about the future." And that is also true whenever it comes to predicting growth rates. So before I talk about how you can estimate potential growth, I would like to highlight the word estimation here. We have different rule of thumbs in terms of doing that, but more than anything else, it's more art than science. There's no really best practice of how to have an accurate prediction of a growth rate because in essence, you're predicting. So a few different things that you can do. The first one is you can listen to the management on the earnings call. You also really need to understand that earnings calls are typically very biased in favor of the company. I would pay very close attention to the track record of the management's earlier predictions about growth rates before I would potentially use that. Then I would say that you also need to understand the business units and you also need to read reports from third parties. So for instance, Google is making most of the money from online advertising. And it's an industry that is expected to grow 15% the next year. This is a number that I have from industry report. So if we assume that this is approximately correct, it's really up to you to determine how much would be captured by Google, how much would be captured by Facebook, and other competitors like Amazon. Very often, these industry reports will also have some of those estimates, but of course, it's also up to you to determine, are they too favorable in Google's favor or not, if that is the company in question. Now, keep also in mind that most listed businesses, especially large cap stocks, have multiple business units. It's important to understand where revenue and profit is coming from. For instance, we can't really use the growth rates of Disney's Marvel movies, even if we have the data, because to predict the growth rates of Disney, we need to understand that the Marvel movies is just one piece of the puzzle to determine the total revenue. And even if you could, you also need to understand how profitable that business unit is. All that being said, there's really no reason to make it more complicated than it is. Now, what does your common sense tell you about this? One thing is what the management says, or what you can find in a report about the industry, or what you can learn in their 10Ks. But what are you thinking as an investor? You invested in the stock in the first place because you understood the industry and the business. And based on what you know about the company, make sure to filter out the noise and then come up with your own growth predictions. And of course, I have to say this here at the very end of my response. Regardless of which growth rate you come up with, make sure to be very conservative. I mean, growth is fantastic, but too many stocks have turned into unprofitable investments because the investors were just too optimistic about the future.
So I really like this question, and it reminds me of my days back in business school because I would make a bunch of professors really angry whenever they would bring up this idea of calculating a value with a beta and looking at the historical price volatility as being your quote-unquote risk. And I would always raise my hand and ask the professor if they thought that maybe the underlying assets of the business and how they are able to sustain their competitive advantage moving into the future with all the other competitors in the marketplace was the actual risk to the business. And I guess this was my way of kind of torquing the whole debate as to how you calculate the intrinsic value of a business, what's important that you're actually looking at. And it goes right at the heart of what you're asking, which is, how can I make a projection with any type of confidence that I'm just making it up or that it's, just a total swag? And so what I would tell you is really dig into the assets and the liabilities of the business, understand what their competition is, understand how stable those future cash flows are going to be based on the asset lines that they have on their balance sheet. So let's say you have a company. That company has one product, and it's the total breadwinner of the company. And that product has been very stable for years on end, and they don't have many competitors in the marketplace. Typically, that's a good sign that they're probably going to have competitors in the marketplace moving forward, but that's where your research comes into play. And if you suspect that environment's going to change, or if you suspect that environment's going to stay steady, Well, now you have a better idea as to how much variance and how wide those angles of your cash flow projections need to be. I always use the example of a hurricane, and whenever they're trying to project where the hurricane's going to hit 7 days in advance, they have a cone of probability as to where the storm's going to hit. There's a most likely course, there's a left and a right limit. I look at future cash flows the exact same way. I kind of have I look at where the storm, the quote unquote storm, has gone, right? Where did the cash flows come from? What did they look like over the last 10 years? And then my projection is kind of interpolating off of that path moving into the future. But if you're going to really put a lot of money into a position, you got to think through what are those underlying assets? What are the liabilities of the company? What's their competitive position, especially for their breadwinning product lines and service lines within that business? And then you got to base those estimates on those variables, in my humble opinion.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.